Hello, welcome to the Joe DeLisi Financial Advisor Podcast. I'm Joe DeLisi. We're going to talk today about why August 22nd was particularly important for your portfolio. Really, what this could be titled is How I Manage Your Money and What I'm Looking For in Markets. Periodically, I like to explain how I look at your different portfolios. So if you're a client of mine, we manage the money in this very specific way. And this might be old hat to you, but if you're newer, I'll quickly explain it. So when we are investing your money, obviously you're never going to hear me call you with a hot tip. We're not going to rotate into different sectors. We're not going to speculate, gamble, or in any way put your money in jeopardy. What we will do is we're looking for historically where risk premiums exist. A risk premium is simply what it sounds like. You take risk. You put your money at risk in terms of going up or down in any given year, any given time period, and you get paid a premium for that. So there are certain risk premiums that we know exist historically. As an example, stocks will tend to outperform bonds over time. Small stocks will tend to outperform large stocks. Value stocks will tend to outperform growth stocks. Now, again, I'm not saying this is going to occur every year. I'm not saying this is going to occur every month, every day, every 5 years. These things tend to go over time. And so what we do is we allocate your portfolios and tilt them to those risk premiums in order to capture those returns. Now, August 22nd was a Friday. And so I look at this every day and all day so that you don't have to. What I'm looking for is what different markets are returning. So during the day, I can see intraday different returns. I can look at the S&P 500. I can look at the Russell 2000, which is small cap growth. I can look at different international portfolios, et cetera. What we saw on August 22nd, it's not unique. It happens several times a year. But this one was just kind of jumped at me because it came on the back end of some potential Fed moves that may or may not even happen. But here's what occurred. On August 22nd, at the end of the day, the S&P 500 index, and I got all of these data points from Yahoo Finance, the S&P 500 was up 1.52%. The Russell 2000, so that would be U.S. small cap growth, was up almost 4%. So the S&P was up 1.5%. Small cap growth was up almost 4%. To put it in a little bit of perspective, MSCI EFA was up about 1.5%. That would be developed countries outside the US. So also I looked at DISUX. Now this is a mutual fund. This one I don't watch during the day. It's not intraday trading. I have to wait until the end of the day where all of that settles so we can see what that individual fund actually did. DISUX is the Dimensional Fund Advisors International Small Cap Value Fund. It makes up, for most of you, probably the largest share of your equity portion, just in terms of how we build out portfolios. That fund was up 2.2% for Friday. So why am I explaining this to you? Well, first of all, let me also give a little bit more context. Okay, so if you look at year to date, and this is, again, through August 22nd of 2025, the S&P 500 was up roughly 10%. The Russell 2000 is up roughly 6%. Large cap international money is up 23%, again, year to date, so roughly 7-8 months or so. And then the International Small Cap Value Fund we mentioned a minute ago is up 36%. So we've got returns all over the place there. So the reason why I think August 22nd was particularly important for you is that what I do, and you can learn to kind of do this for yourself. Now, a lot of you will ask me, you want to see your portfolio every day. I think that's a mistake. I don't think you really want to look at your portfolio every day. That's what I'm here to do. What might make sense is you can kind of look at markets in general and look at several different markets and just to kind of get an idea of how, things are moving. So when I open up the total amount of money that I manage for all of my clients, roughly that portfolio is up about 1.9% across all the money I manage, okay? Where that makes sense, right? So that's what I'm looking for. So if the S&P is up 1.5 on Friday and the Russell 2000 was up 3.9 on Friday, and we have all these different returns, what I know is that, okay, my client portfolios are tilted where? They're tilted to small, they're tilted to value. We've got almost equally international to domestic. So if the S&P is up 1.5%, stands to reason my client portfolios in aggregate would be up higher than that. Now, here's why this is kind of significant. I'm saying that my client portfolios, again, and this is an unaudited return, right? It's just me looking at the total amount of money that I manage. That was up roughly 1.9%. What's interesting about that, and I don't have these exact numbers with me, but you guys are not all aggregately invested 100% in equities. I've got a lot of retirees. I've got a lot of pre-retirees. I've got people with lower risk tolerances than maybe I do. My own personal money is 95% in the equity markets. So, let's say that, and I'm just saying generally speaking, let's say that 70% of the money that we manage is in equities across the globe. That would play into our total return as well. So what I'm looking for is this. If the S&P is up, in this case, 1.5%, but, the small cap growth is up almost 4 and international money is up over 2, what I should see is that our portfolios are up higher than the S&P 500. The converse is true as well. So if the S&P has an incredible run, like last year, the past few years, then the portfolios should be lower than what the S&P is. This year, we're seeing the opposite of that, right? In fact, it's been going on longer than just this year. It's been going on for about a year and a half. So as I mentioned before, that DISUX, which is a very large proponent of your equity pieces, that's up 36% year to date. The S&P is up about 10. And so what I do again is I'm looking at it going, all right, if our portfolios are working the way they're supposed to work, then my client's money should be growing faster than the S&P 500 as long as you're in equities, which this year is what's happening. Now, will that continue? Who knows? We don't know month over month, day over day, year over year, but we do know over long periods of time that's going to happen. And so that's why we have you that way. The other thing I'll do is this, is I'll kind of periodically, now several of you probably just had an annual review with me. So obviously I'm pulling your portfolios down, looking at them, analyzing them for the year, making sure that they're moving the way that they're supposed to be moving, et cetera. But I don't just do that on annual reviews. What I do is pretty much weekly, I just sample client portfolios almost at random. And what I'm looking for again is, are these portfolios moving the way that we built them? Why am I looking for that? Really what my job is to make sure of is that, look, if we allocate you to these risk premiums, that's just part of the job. But then the portfolios have to work. If for any reason we're not seeing portfolios moving in the direction that these different markets are actually moving, well, then something's wrong. It's either wrong at the fund level or ETF level, or it's wrong at the allocation level. Now, I can tell you, we've never had that. Even in 2020, when we had massive swings, portfolios moved exactly the way we would expect them to. Again, we don't know if they're going to be up or down, but they are moving in the right direction. And so for me, what I say is that means they're not broken. That's what I'm looking for. If ever we have a situation where portfolios are quote unquote broken, I always say that's when I would worry. That's when you would get phone calls from me. It'll never be for a hot tip. It'll never be to rotate you into the real estate sector, tech sector, or any of it, right? We're not doing that. We build it on science, but we don't just let it sit there and ignore it. Just because it's built on science and data doesn't mean the job's done. And so I'm looking at this all day long, intraday, at the end of the day. Then I'm looking at your portfolios. Did they move correspondingly the way they were supposed to? If they are, great, thumbs up, great, continue on. And then obviously what we're doing is also walking you through year-to-date numbers, inception numbers since you've been in the portfolios, et cetera. So that's what we're looking for. That's how we build the portfolios. That's what we're looking at day-to-day, literally, on these portfolios, just to kind of give you a little insight as to how do we manage your money. That's all for today. We'll see you next time.
Registered representative and financial advisor of Park Avenue Securities, LLC. OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California 92112-619-684-6400. Securities products and advisory services offered through past member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, NY. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, DBA Westpac Wealth Partners, LLC. See insurance license number 083413. This podcast is for informational purposes only, is not to be construed as tax, legal, investment advice. Although the information has been gathered from sources believed to be reliable, please note individual situations can vary. Therefore, the information should be relied upon only when when coordinated with the Mudico professional advice. Guardian and its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Guardian and its subsidiaries do not issue advice of the card mortgages, property and casualty insurance, and/or car insurance. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, in the Zoom market, interest rate, issuer credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. 8339041.1 expires September 2027.